Hello class, in this video we are going to talk about Chapter 2, which is Job Order Costing, Calculating Unit Product Cost. So let's get started. Now, job order costing is a system that is used when manufacturers or producers are making a product that is not the same among the various products. So you're making different kinds of products and they all do not look the same. This is, like number 2 here says, products are manufactured to order. And number 3, the unique nature of each order requires tracing or allocating cost to each job and maintaining cost records for each job. What this means is that each individual job requires different materials, different labor than the other jobs. And of course, we'll apply overhead to those jobs according to some kind of basis we're going to talk about a little bit later. Now, an example of someone that would use job order costing would be like Boeing. Various models of aircraft, of course, require different materials. You have different number of seats. The fuselage is larger or smaller depending on the aircraft. So each aircraft they produce is not the same. Bechtel International, it's a large construction company. They may be manufacturing or producing an airport for one city, building it. Another place they might be building highways. So each project is different, again requiring different materials, different labor, and then different overhead needs to be attached to it. Movie studios also are examples of job order cost system users. Each movie that's produced requires different cost involved, different location cost, different actor/actresses cost, and so forth. So this is what we're looking for in job order costing. The item being produced is different from the next item being produced. So let's talk about the cost. First of all, we need to attach direct materials to each job that's being produced. For example, let's say job number 1 is a builder of a one-story house. So you're going to have different materials, labor, and overhead for that job. If that same producer is making a two-story house, again, you're going to have more materials involved and more labor involved. And number 3, if it was an office building, a lot of different materials involved. So this is, again, to show you that each product, in this case each job as they're saying, is different. Labor is the same way when you attach the labor cost. You keep up with who works on what job. So you have various employees, and if they work on job number 1, you allocate their labor cost to that job. If they work on job number 3, for example, you allocate their labor to that job. So each job needs to pick up its cost, its labor cost, its material cost. Indirect cost, these are the manufacturing overhead cost, and you remember these from Chapter 1. We need to allocate a certain amount of overhead to each job. And so probably you'll allocate less overhead to a one-story house than you would a two-story house, and then probably less to a two-story house than you would an office building. And we're going to see how to allocate this manufacturing overhead to these various jobs in just a few minutes. Here's an example of a job cost sheet. Here we're saying that job number A-143, and the item is a wooden cargo crate. We're going to produce these. So what you need is either on paper or, like most companies do these days, on the computer, something similar to this where you can keep up with the various materials this job uses, the various labor, people working on it, and how much overhead we attach to this job. Then we're going to find the total cost of that job, and depending on how many units that we produce, we're going to divide the total cost by the units to get a unit cost. Here's how we will start to fill it out as we start using materials for this job. And we have requisitioned a certain type of material. The cost is $116. So we place that down here in the cost summary. So far we've allocated direct materials at a total cost of $116 to this job. Now labor, let's do the same thing. We have ticket number 36. Someone worked on this job for 8 hours, and so we applied $120 of direct labor cost to this job. Now remember, these hours are worked only on this job. If this was a different job like A-144, you would have different workers working on that job, and their hours and direct labor cost will be attached to that other job. So this ticket summarizes only the materials, only the labor, and we're going to see here in a minute part of the overhead that belongs just to this job. Now, to attach overhead to jobs in the job order cost system, we need to figure out some way to determine how much each job should pick up of the total overhead cost for the company. We need to come up with an allocation base. Now, why do we need this? Well, one reason, it is impossible or difficult to trace overhead cost to particular jobs. As you remember in Chapter 1, overhead cost could be like the utility cost for the whole factory building. Anything made in the factory building, yes, uses some of the overhead cost, but it's hard to attach a certain amount per utility bill, like how much electricity does a particular job use, how much of the water does it use. So we lump all that together as overhead, and then we allocate that to the different jobs. B, it says manufacturing overhead consists of many different items ranging from the grease used in machines to the production manager's salary. So yes, in the manufacturing overhead area, we have not only utilities, like I said a minute ago, we have manager salaries, supervisor salaries, like it says here, grease used in the machines, repair and maintenance for the machines, depreciation on the machines, property taxes for the factory building. A whole variety of costs will be picked up in manufacturing overhead, and we need to figure out a way to get that attached to the various products being produced. Part C, many different types of manufacturing overhead costs are fixed even though output fluctuates during the period. So in overhead, we're going to have some fixed cost, most of it might be fixed, and we will have some variable cost. We need to find out a predetermined overhead rate. That's the POHR, and we're going to use that to apply overhead to the various jobs. To calculate this, you can see sort of a quite wordy numerator as well as denominator. The numerator, estimated total manufacturing overhead cost for the coming period. The numerator, estimated total units in the allocation base for the coming period. Now the allocation base is the cost driver that causes overhead. This should be the activity or something that's driving these costs, that are causing these costs to occur. So let's look at some examples. Now, to calculate the predetermined overhead rate, we need to, first of all, find the actual overhead for the period. It's not known until the end of the period, but we have to estimate it. So we have to estimate for the entire period coming up what the overhead is going to be. And the period is usually a year. So before January starts, we're estimating for the entire year, January through December, what the total overhead cost will be for our manufacturing cost. Number 2, actual overhead costs can fluctuate seasonally, thus misleading decision makers. Let's say, for example, you have a large, extra large heating bill during the winter months, but your air conditioning bill is not too bad during the summer months. What you need to do is have a consistent overhead cost attached to units being made no matter when they're made during the year. So we should have the same overhead attached to units made in January and February as the ones made, let's say, in May and June. The predetermined overhead rate is computed before the period begins. Just talked about that. You estimate the overhead. Well, first of all, we estimate the allocation base before the period begins. Then we estimate the total fixed manufacturing overhead cost for the period coming up and the variable cost for the allocation base. So these both are estimates. We estimate the allocation base. And we're going to see in a minute the allocation base can be like machine hours, direct labor hours, or some other activity. So we estimate the number of, let's say, direct labor hours going to be used, and then we estimate the total manufacturing cost, both fixed and variable, for the period coming up. Once you get those done, then what we're going to do is try to figure out how much is that total manufacturing overhead. So we have the formula y equals a plus bx. Y is the estimated total manufacturing overhead cost for the period. A is the fixed manufacturing cost for the period, the total fixed manufacturing cost for the period. B is the estimated variable manufacturing cost per unit of allocation base. So this can be per unit of direct labor hours if you're using that, machine hours if you're using that. And X, of course, is the total amount of the allocation base, like total direct labor hours or total machine hours. And then you use this to help compute the predetermined overhead rate. Let's throw some numbers in the mix. We estimate we're going to have 160,000 direct labor hours during the coming year to meet production level. That's the allocation base. We estimate the total fixed manufacturing overhead cost will be $200,000. And the variable overhead cost per direct labor hour is $2.75. So throwing the numbers in the formula, we have the fixed cost plus variable cost per unit times the total number of units of the allocation base, in this case direct labor hours. Let's solve for Y, and we get $640,000, which is the total manufacturing cost for the period coming up. This is the estimated cost. This is total fixed and variable cost for the period coming up, for the year coming up. Throw it into the formula we saw earlier. So we have $640,000 total overhead divided by the allocation direct labor hours amount, 160,000 hours. And so our predetermined overhead rate is $4 per direct labor hour. Now what we're going to do is, when we complete a job, then we will know how many direct labor hours were used to complete that job. And we're going to take those number of hours times $4. And that's going to give us how much overhead to attach to that job. And remember, a job can be a certain number of units, but we're going to attach this to the job in total according to direct labor hours in this example times $4 per hour. The entry then to do this, if you go back to the job cost sheet a couple of slides back, you'll see we used 8 direct labor hours. That's what this stands for, 8 direct labor hours. We just saw the $4 predetermined overhead rate, so $32 is the amount we attach to this job. The entry, debit work in process, $32. Credit manufacturing overhead, it has its own separate account, $32. Then you can see, here's what we did. We now add $32 to finish out the total cost of this job. So we have the materials cost, direct labor cost, and manufacturing overhead cost. Now here, don't get confused. We've already added direct labor cost of $120. This is the labor we are paying the workers on this job. We did use their hours they worked to help find the amount of overhead we need to attach. So we're not combining these two, we're keeping them separate. So make sure you have 3 separate costs here. Direct materials, they're sort of there by themselves. Direct labor, these are the labor cost of the workers. And then we use direct labor hours to now attach to this job an amount for manufacturing overhead. Add them all together. Our total cost for this job is $268. Here we computed 2 units. So this job was for 2 units of this item, 2 crates. It cost us $268 total. Divide by 2, so each unit cost $134. So find the total cost for the job, materials, labor, and overhead we're attaching to it, total cost, and now divide the total cost by the number of units. And so here it's $134. If the number of units had been, let's say, 10 units here, we would take 10 units, divide into $268, and the per unit cost would be $26.80 if it had been 10 units. But of course, it's only 2 units, so 2 divided into 268 is $134 per unit. Now what we do is use these numbers for both internal and external reporting. The amount of overhead applied to all jobs during a period will differ from the actual amount of actual overhead cost incurred during the period. What that means is, before we started the period, we estimated what we thought the total manufacturing costs were going to be for the year coming up. We use that to find a predetermined overhead rate. In this example I slided to earlier, remember $4 per hour, per direct labor hour. We apply that to the units being made during the year. But when we get to the end of the year, since we started and used estimates, we compare those to the actual at the end of the year, and it's never going to be the same. Hopefully it won't be too far off, but it'll never be the same. So number 1 here says, when a company applies less overhead to production than it actually incurs, it creates what is known as under-applied overhead. We did not apply enough overhead to the products during the year as we should have. Of course, we did not have perfect knowledge, so we will always have either an over or under-applied overhead to deal with. Number 2 is just opposite. When we apply more overhead to the production than it actually incurs, it results in over-applied. So we've attached too much overhead. So we have over-applied overhead to production, which that's okay as long as it's not a huge amount. That's okay. So how do we deal with this? Well, what we do with the under-applied or even the over-applied overhead we have at the end of the year, we run that into cost of goods sold. So I have here, see page 125 of your textbook. And if you look at that page, you can pause the video here so you can find the page. But when you find the page, you'll see halfway down, number 14, we're going to debit cost of goods sold, in the book example $5,000, and credit manufacturing overhead. That's an example of, I guess you can say, getting rid of the under-applied overhead we had at the end of the year. We did not apply enough overhead, therefore we did not have enough attached to the jobs as they went through the system, as they went into finished goods, and then most of them end up in cost of goods sold. So now we need to attach more cost to cost of goods sold because of this under-applied overhead. And since hopefully this dollar amount will be immaterial, according to all the costs you have in your company, immaterial, we can just throw it all into cost of goods sold. So again, looking at that example on page 125, we are debiting cost of goods sold to increase it, and we are crediting manufacturing overhead, and that will bring that account to 0. Number 2, it's just opposite. And so if we over-applied overhead, we need to take some cost out of cost of goods sold. So we need to decrease cost of goods sold. So I don't have an example in the book for you for that, but it'll be just the opposite of what you would see on page 125. We would debit the manufacturing overhead account, and we would credit the cost of goods sold account. And that would have the effect of lowering cost of goods sold. Why? Because we attached too much overhead to the units as we went through the year. Again, one more time. Hopefully, the under-applied or over-applied overhead will not be a very large amount. So if your estimates are good, then hopefully this will be pretty close, but you will always have it. So there's just an easy way to get rid of it at the end of the year. And what you're going to end up doing is bringing your manufacturing overhead account to 0. If you look at a T account for manufacturing overhead, on the left side, the debit side, that's where you're going to enter the actual cost you incur for overhead. Utility cost, property tax cost, supervisor salaries, janitor salaries, manager salaries will go on the left side. And then as you apply overhead, attach it to production, you're going to credit the overhead account. You're going to credit the overhead account when you debit work in process. So the entry to allocate and attach manufacturing overhead cost to your work that you've just completed is to debit work in process inventory, it's inventory account, and credit manufacturing overhead. Now, you can use this job order costing system for service companies as well. It's not just for manufacturing. And it says here examples: law firms, accounting firms, medical treatment. For example, if you have to go into the hospital, then you will be charged. You're like a job to the hospital. You'll be charged with what services you use and what products you use. So anyone that comes by, the physicians, medical experts, the pills that you take, any kind of equipment that you end up using, it'll be charged to you. The person in the room next door, they have a different illness or different injury, and they will have different costs attached to them. So if you want to think about it like that, when you go to the hospital, you're like a job to them. Accounting-wise, you're like a job, and you will be charged with everything that you use. So that's a quick overview of Chapter 2. Again, please go back and read the chapter very well. Follow the examples through in the chapter. Follow the numbers. Make sure you understand the computations. Follow the journal entries. So again, please read the chapter carefully, and good luck with your studies.